Yes. Have you tried sharing your screen?
Yeah, but it says that I need to get permission.
Permission. Okay. It's coming from the corporate or Saud account. So give me 1 minute to sort it out.
In the meanwhile, I should can say we see a lot of people now assembling from all over the world. Very, very inspiring to see, and looking very much forward to the session today. And I can say a little bit. The idea will be that I will try to give some sort of perspective on the standard, but definitely also the idea here is to have a bit of a conversation and a bit back and forth, because the really cool thing is that all of us, we're working within the context of the same regulatory standard, all throughout the world. This sort of IFRS is a worldwide standard, so we all struggle with it. On the other hand, that also means the potential for us to learn from each other. So looking very much forward to the discussion.
Yes. Welcome everybody to our webinar. Thank you. First, I'd like to extend my sincere appreciation to Jacob for accepting our invitation from the University of Dar es Salaam in Tanzania to host this webinar. It is a timely and very relevant topic. And as you can see, it is we are all working in the financial sector throughout the world. We have a number, you can get it from the chat, a number of people from India, from Zimbabwe, from Pakistan, and the like. So I'm also looking forward for a very invigorating and a lively discussion. Jacob, you have already been given permission to share your screen.
Oh, excellent, excellent.
So
let's see, it says I need permission to share. Let's see if there is a trouble on my side. Okay, let me. Sorry, it could be that it is on my side, and the trouble is. We will see if this works. Let's see. We try one more thing. Otherwise, I have a little bit of a sort of backup solution. No, okay. Now. No, it okay. No, it didn't know. Okay, then we'll sort that, because I'm pretty sure it is my the web browser that's blocking it. Let me just very quickly just send myself the presentation, and I will log in from my phone. So please give me.
Yes, we understand the technological challenges.
We will be able to resolve this.
Yes. In the meantime, the president of Students Association, Asaud from University of Dar es Salaam, or the vice president, please welcome us. You have a minute. I can see the vice president. You're right here. Amos. Or the president, Oscar, if you're in this call.
Thank you. Thank you so much, moderator, for this opportunity. Well, I am Amos Mazanda, the current vice president of the Actuarial Association of University of Dar es Salaam. Yeah, it has been a very nice moment for us to have this webinar here. Yeah, we thank you, the facilitator, and we expect to learn a lot from what you're going to explain or to present on the IFRS. So we're looking forward to learn a lot from this session. Yeah, so we are here to represent the Student Association of the University of Dar es Salaam. The students who take actuarial science are in here. and other alumni who have ever studied actuarial science. So thank you for this time, and we expect to learn a lot from this. Thank you, moderator.
You're welcome. Jacob, are you okay on your end?
I'm almost finished. I will just have to transfer it to my phone.
Okay.
And,
In the meantime,
yeah.
let me engage with those who are coming from different parts. We have a program at the University of Dar es Salaam, BSc in Actuarial Science, which is a 3 years program. In this program, the actuaries majorly work in 5 areas, which are pensions and social security. They also work in insurance, both non-life and life. And then they work in investments, banks and financial institutions. They're called the investment actuaries. They are quantitative risk managers. That path is called ERM, which is enterprise risk management. And the 5th one is fintech, financial technologies, the emerging technologies. So this webinar with Jacob, it takes care of the one part of the actuarial specialization, which is enterprise risk management and investment actuary, the ones who are mostly concentrated in corporate banks and investment banks. So welcome everybody. And in a few seconds, a minute or so, Jacob will be able to share his screen and give us the presentation. Please do engage in the chat. Write your questions there, right there. And me and my team. Cyan, please mute your mic. Me and my team will do our best to actually answer your questions. And then in the process of moderation, we'll also be able to give the Jacob, our presenter, to answer some of the questions. And I hope by the end, Jacob will also be given a way we can move this chat into the LinkedIn so that we'll be able to give each other this information. Thank you. And Jacob, over to you.
Exactly. So give me just a few seconds more and I will be ready. Sorry, I also need to fix the double sound here. Let's see. Let me actually do that. It may be easier to log out from here. Little bit of a setup here, but now I think we should soon be able to see my screen. And let's see if we can get it, and or we might have to. Let's see if is my screen visible at the moment?
Yes, it is, but it's quite minimal. Yes, that's much better. Yeah, that's much better.
Yes. Okay. Good. Really excellent. I should also say that I'm at the moment unable to see the chat. So if you if there come up some interesting question in the chat, feel free to bring it out, because I think it's very nice to bring the questions as they come along.
Oh, sure. I will do that.
Yeah. Let me also move this one. Okay. Finally, again, my dearest apologies that it took a little bit of time to get this working, but now we are on the road. So let's actually start this talk by giving a bit of a perspective on what is, why did we get IFRS 9 as a concept to start with? So first and foremost, let me see if I can here to take myself forward. So, we used to have an old standard back, which was called IS 39. And the IS 39 standard, it was developed sort of back in the late 1900s, and it was applied in the beginning of the 20th hundred. And the interesting thing was that the standard that preceded IS 39 allowed you to make forward-looking provisions. But the problem a lot of people within ISAB felt was that this was misused by the banks. So it was actually, you could almost say a little bit of a reversal to what we have today. So they said, no, we don't want banks to make these forward-looking assessments. We don't want banks to calculate this, because what we see is the risk is that the banks sort of, they try to trick around with their profits. They try to orient it like this. This is not something that we want the bank to be doing or operating with. Instead, what we want the banks to be doing is to really focus on, what is the actual objective evidence. Now, the problem, though, was that if you think about what the consequences of this was that if you have a simple debt instruments, in this incurred loss model, what you would do is you would only apply losses on it if it goes beyond 90 days delinquent, or this classical default definition. That would be the only place where you would then apply the losses, and you would write down the value. And the issue then was that, first and foremost, you should say, if you are in equilibrium, so if you're operating on a portfolio in total equilibrium, from a P&L perspective, it doesn't really matter what type of incurred loss standard you have. So you could imagine a standard where you only basically take things upon write-off, and that's the only loss impairments that you have. Or you could imagine a standard like what we do in the US CFO, that you take the ECL right at the very start, and you take the very lifetime. And from a P&L perspective, it's not going to matter if the portfolio is in equilibrium. In equilibrium, this is all going to be the same, and it's not really going to make that much of a difference. But it will really matter from either. Sorry. Yeah, sorry. So it will really matter from two different perspectives. One perspective is that it will still matter from a balance sheet perspective. So if you make very early loss estimations, you will effectively increase your capital requirement. And it will also matter, and here is where IFRS 9 in particular comes in, it will really matter from a cyclical perspective. Because what we see, and you see sort of, in the picture I've shown here, what you can see is the orange line shows the growth in the credit portfolios, and the blue line shows the losses. So what you really see is that you had sort of a lot of years with a lot of large growth and pretty low losses, and then when the financial crisis came, this all inverted. And the problem a lot of people realized was that when you have good times, and if you don't have to make any loss estimation because the portfolio is not yet default, okay, that means that you have many good years, and you just basically push out loans into the market. And then once these loans are out in the market, at then some later points, suddenly, the economy turns bad, and then you get all of the losses. But then you might have a different management, which was then what was originally the ones that enforced it. And I think here is sort of part of the issue that, you don't want the credit cycle to be, boom and bust. You would really like it to be a very sort of, stable cycle that it would operate on. And this is part of sort of the issues that was created with this old loss recognition method, that you would have sort of, you would have this sort of, cyclical behavior that wouldn't really work in a good way. So if we move on to then talking about, when after the financial crisis came, or let's see if it's this way. Yes, it's this way I should type. So when the financial crisis came, the default rates were going up quite a lot. And the problem then was that a lot of people realized that, that was sitting like, small investors that were sitting with bank stocks, they realized that, okay, look, a bank stock is much more risky than I had realized. And in particular, you had some banks that started showing big losses, but you had some banks that yet had not shown too much losses at all. And a lot of investors started asking them, okay, look, this bank, okay, now it looks good. But is it good because the stuff in it has not yet defaulted? It's just a timing question. Eventually, it will go bad. Or is it that rather the reverse, that, what is happening here is that the underlying quality is good. And there was really no way to tell. there was too little disclosures to tell investors if what is in the bank's balance sheet is good or not. And this is the big motivation behind IFRS 9. The idea is that we want to be able to tell our minority investors, because remember, majority investors, they sit on the board, they will know what the credit quality is on the inside, but the minority investors, they will not be aware of what is happening within the bank. So they need to be able to get reasonable disclosures on what is the credit quality. And so basically, as I say, there are sort of two major questions you could ask. You could ask, how much loans have already gone bad that we know from IAS 39, the incurred loss standard. But you could also ask what future losses is to be expected. And in the old standard, you had no information about this. And IASB then did the International Accounting Standard Board, they did a number of outreach that showed that, if you make sort of pro forma adjustments, that a lot of analysts were doing these sort of pro forma adjustments that basically were trying to figure out this, how much loans are going to go bad. And it would be much better, instead of, the bank sitting or the investor sitting and guessing, that the bank would disclose information. So this was sort of the context. Now, the first thing that was thought a lot about was using fair value accounting. So in fair value accounting, what you focus on is basically what is the market value of the securities. Now, on one hand, fair value accounting is a very sensible thing to be looking at here, because imagine that you are, for example, a bond trader. So you buy, for example, sovereign bonds, and you trade with them back and forth. I mean, then, if you're now worried about, or corporate, let's say corporate bonds for simplicity. So you buy a number of corporate bonds and you sit and you trade them. And if suddenly the credit quality of the issuers, so, the corporates, if they deteriorate, the bond is going to lose value when the market realizes like, oh shit, these guys are not going to be able to pay us back. Then the bond value is going to go down. And notice very importantly that the bond value goes down even before there is an objective loss event. So if I have borrowed a ton of money to a company through a bond, and suddenly that company comes out with financial reports that show that they seem to have actually some real problems. They could actually be in a trouble where they might not be able to pay back. The bond value is already now going to be affected. So the bond value is very forward-looking. And this was IASB idea. They said, look, this is what we really want. We want is that, when something happened with your loan portfolio, it should be reflected straight away. So maybe we should do fair value accounting. However, that did not really work. And the problem is that because in fair value accounting, first and foremost, a bond has a liquid market. So that's where you get the price from. But most of the things that you have in your loan book, your classical loans, your corporate loans, your mortgages and so on, there's no liquid market for these. So it would be incredibly hard for you to be able to estimate that. And you even saw that, during the financial crisis, there were companies that had certain loans under fair value accounting that actually had to give up, because when the crisis really hit, there no longer were an active market for these products. So actually they had to go back onto more a cost accounting measure. And it would also create a lot of problems to do full fair value accounting, which is something which is quite popular among academics. So I attended a conference a few weeks ago in Oxford. And it was interesting to discuss with a lot of academics there, because a lot of people there argued quite strongly for fair value accounting and said that, this gives the most reasonable view. Now, one of the key problems with fair value accounting is that assume that, I go to the CEO one quarter and I say, look, we're going to book a massive loss this quarter. And the CFO, he gets really scared. He said, okay, why are we booking losses? And I said, no, because the market is in very turmoil now and nobody wants to buy our mortgages. So the market value, the mark-to-market value, the fair value of our mortgages is much lower. So we're going to book a loss. And the CFO, he looks at me, he's very perplexed, and he said, no, but look, that doesn't make any sense because we're not going to sell this. I mean, we're not going to sell our mortgages. We want to have our mortgages forever. So why are you booking a loss? And that's the problem you would be in if you did fair value accounting. So you would basically have to reflect a lot of market events that don't really impact the company. The credit risk side, this fact that, if a counterparty is of worse credit quality, I will take losses. That's a real effect. But this fact that the market is less willing to pay for mortgages because the market is in turmoil, that's not necessarily an effect we want in the bank's balance sheet. we should focus, as I say in the last point here, we should focus on the recoverability, what is expected to not be collected. So basically what we are seeking for is a solution which is sort of, it should give us relevant information. We should be able to compare the credit quality between companies. The standard should faithfully represent the economic reality of the business model the assets are in. There should be a simple interpretation of the results to make the standard, to make it understandable. And we should be able to verify the calculations against objective reality. So then the next idea that was thought, okay, so this first, pure fair value calculation, it's not going to work. ISAB then had their next idea. And you might say, okay, why do you go through sort of an entire history? We will soon see that it becomes quite essential to understand some of the quirks of IFRS 9. Because the next idea of ISAB was to say, okay, let's do something that's very similar to a fair value calculation, but let's focus primarily on credit losses. So they said, let's do a discounted cash flow calculation. And I think quite a few of you here have seen a discounted cash flow calculation. So what you do here is you take the credit losses, you take the contractual cash flows that you expect, you build some sort of model for the losses. We will come back later to talk about how you do loss modeling. But you build a model for the losses. And then what you do is that you then discount this with a discount rate. And this is the fair value of the asset. Now, if you then, it's a little bit tricky and said, look, the fair value of the asset when I originate should really be, what is the balance to start with? So then I can actually solve for this discounting rate, which is called the credit adjusted effective discounting rate. And through this method, I can then, if then later on the losses goes up, what is going to happen in this expression if the losses goes up? Well, if the losses goes up, the value of the asset will go down. So here I have a pretty nice way of representing the value of a loan. And similar, if the cash flows would change, okay, then it's going to go up instead, for example. But the banking industry did not really like this solution. So in 2009, ISAB published this. The banking industry was very upset about this method. And straight out said that, okay, it will be way too complicated for us because we will have to do this very complicated equation solving. We will have to include both the losses and the accounting side in the same equation. That doesn't really work for us. I don't necessarily think that's a super fair argument, but in the end, that is the argument that won out. And so ISAB had to go on and said, look, okay, this was what we really wanted. And it's still, to this day, if you read what's called basis for conclusion, the material that sort of gives you the rationale for IFRS 9, it is still what ISAB write is the theoretically most correct value. But they said, for practical expedience, we have decided to alter the standard. So how did they alter it? Well, they pointed out that if you make investments in debt investments are very, very different from, your normal sort of equity investments. Let's see. You have to make a shortly go back here and said, the DCF calculation, you typically use that for equity valuations. Now, if you compare an equity to a debt instrument, how are these two different? Well, an equity instrument, you take a little bit or you buy a little bit of stock in a company. If you buy, for example, stock in a bunch of startup companies, you can take actually pretty large risks because if just one of these companies are successful, that stock is going to go through the roof and that's going to pay back for all your losers. So you have these sort of, venture capital funds. They often talk about, 10x. They talk about, winning on one of the stocks will pay back for all the rest. But if you think about that you're a debt investor, you actually have to think the total reversal. Because on debt, let's say that I lend to 10 companies, 9 of them fails, 1 of them is a very successful company. Is that going to work out in a good way for me? No, that's going to be really, really terrible. Because the debt, the company that went very well, they just need to pay me back what they owe me contractually. I charge them like a 5 or 10% interest. Okay, so they pay me back 5 or 10% interest, and that's all I get. But on all these guys that failed, there I might lose quite a lot. So in debt investments, the upside is often very small, but the downside is very, very large. And ISAB said, look, that's a pretty interesting idea, that if you have these investments that are based around this philosophy, what you could do is that you can have a different type of accounting method that more reflect this, limited downside method. The idea was then to say that, okay, look, we segregate these out, and for these we will use what we then show is this IFRS 9 method. But there are actually one special type of investments for which you still use this discounted cash flow calculation that I showed before, and that is for distressed debt. So if I buy distressed debt, I still to this day will use this discounted cash flow calculation, and it's called the POCI, the purchase or origination of credit impaired asset. Because if you buy distressed debt, you often pay very little. You maybe pay 10% for the distressed debt, but your upside is huge. If you get the customer paying, you can actually collect everything on it. So we will say, we will put those investments to the side because they are more of a special type of IFRS 9 that's not so super common. But it's important already to know that, the reason now we're talking about the very special accounting method here is because we say we have this small upside, very large sort of downside. And shortly, we also need, for this all to work, we need to have very simple and very understandable cash flows. If not, you have to go back to this fair value accounting. And I will show here, sort of two interesting examples for this SPPI test. SPPI stands for can I show this if I go a step back? So it says, solely payments of principal and interest. And the SPPI test here I show sort of, if you can have sort of, a number of different alternatives. One is I show an example where you can have some countries is very popular with bonds, where the coupons are linked to the inflation index in the country. And you can say, okay, is this an instrument that we can, that we are allowed to use IFRS 9, the amortized cost for? Yes, because the logic is that inflation is often tied very strongly to, time value of money. So it passes the test because there's no sort of, strange exposure or something. I give another example. You can have a mortgage where the payments depend on the income of the borrower. That would not be permitted because in that case, it would almost be more like an equity invested into the person that you have borrowed. So that would not be permitted for the SPPI context. So, what was the solution then that was selected? Now we have seen the fair value solution. We have seen the solution of this discounted cash flow model. How are we now going to operate on normal loan investments? And the solution was a two-step model. So you do step one, you do to determine the effective interest rate. So this is the first equation that you can see here. What you're doing is you look at the contractual cash flows that you have. You then take and say those at origination, if I discount them back to today, they should be equal to the balance of the loan, unless I make some very special element or something in the loan. But they should be equal to the fair value, which is typically equal to the balance for a normal loan with no sort of strange features in it. And then I can solve for the effective interest rate. So from the first part of the equation, I get the effective interest rate. In the first part, I assume there is no credit losses at all. There's no risk at all. So I calculate with the instrument that's risk-free. And the idea why that is a reasonable approximation is, as I said, because we typically have, very little upside and very large downside, you only tend to give loans when the risk is not too large. So this is also the logic why this sort of method sort of works. And it also means that if you give out more risky loans, your accounting will be more sort of skewed and harder to understand. You still have to unfortunately calculate this way, but it will be a more skewed accounting. Now, then second step is that you have to calculate the credit losses. So how do you calculate the credit losses? Well, you take the losses and then you discount them with a discount rate. Now, if we sort of, go back to the method we had previously, notice that, you still had credit losses, you had contractual cash flows minus credit losses. But notice that you calculate a joint discount rate so that all of this together became equal to the balance. But in this case, you instead have that, the first part is just equal to the balance. So what it means is that when you take the gross value minus the ECL, that's going to be lower to the balance. This is the day one effect. So this is fundamentally why you have that already at origination, you take a loss, and the loss will be larger the more risky the credit is. Now that is fundamentally sort of not really correct from if we think about the valuation point of view, and this is something ISFP point out, because if I give out a pretty risky loan, and I do that with sort of good information, I will typically charge a higher effective interest rate. And if I charge a higher effective interest rate, typically then I will be able to cover some of the losses using it. And this will be reflected in the discounted cash flow method, but it's not correctly reflected here. And this is why we get the day one effect, so that already day one you take a bit of a loss already. This is the reason why you get in that issue. So, having that said, so now we sort of, we have been able to obtain sort of, the expected credit losses here. Now, how should we then think about, what is an ECL really as a concept? Well, there are two ways you can think about an ECL. One way is to view it a little bit like a form of piggy bank almost. So what you do is, if you think about your equity of the bank, what you really say is you take aside a part of the equity, you basically lock it up and say this part of the equity cannot be touched. It cannot be distributed as dividends. It cannot be used to fulfill my capital requirements. This equity is locked because I know there will be some future losses, and I will use this little equity reserve in order to pay for those future losses. Because your losses always comes out of the equity, because if your losses comes out of the debts that you hold as a bank, you go bankrupt because you should always pay back to your debt holders. So that's one way. You view it almost a little bit of a sort of equity piggy bank that you set aside as loss reserves. Another way of viewing it is that you instead view it as that you take this risk asset and you say, okay, I have an equivalent risk-free asset that is a smaller value. So I have this big risk asset, and I take away the sort of unhealthy chunk of it, and I have the sort of healthy part that remains. So you almost view each loan you view as two loans, one that is bad quality and one that is good quality. So you make this split in the loan pile as two. Okay, so now we have set a little bit of the stage here. And the idea now is let's actually move in and start talking about how do you calculate these impairments. So if you think about the formula that we derived here, what we are supposed to do and what the standard tells us to do is to take and calculate the losses, the shortfalls sort of from what we are owed contractually. So you take each of these shortfalls and you're to discount them using the effective interest rate. And that's it. So, you could say, okay, here's the formula. No need to continue the presentation. All is well. Of course, I think you all know that there's going to be more to this story than just writing down this formula and me, logging off the call. Because at the end of the day, this formula stares you a little bit in the face. Okay, so losses, where do I get losses from? Okay, so if you think that you have a pool of loans, for example, to obtain this loss number, you would have to estimate each month. I have today this pool of loans. Each month, how much losses will I take on each of them? Or each lot, what is the expected value of losses I think I will take each month? That is a really hard number just to ballpark. I mean, it's very hard to get the intuition for it. And the first idea to realize that it's pretty tricky is that you're realizing that if you run a sensible lending apparatus and you are quite responsible as a bank, as you should be, most of your loans will never, ever take a loss on. So most of the loans that you give out, customer will just pay you, you will get the monthly interest from them, everything will be, sunshine. And then you will have a small pool of loans that turn bad. This is a very important insight. And again, it is very different from the equity case. In the equity case, most of if you are, for example, in speculative stocks, most of your stocks might underperform and then a few massively overperform. But in debt investment, it's a reverse. Since you have very little upside, most of your loans need to perform really well, and then only a few of them can perform quite crappy. So what you realize is it's a minority on your loans where you even take any losses at all. So first and most, just using calculate loss for every loan is quite misleading. So we will need a method to first determine in this pool of loans, which loans do I think actually is going to become those bad loans where I take losses on. That's the first thing we will have to think about. The second thing to think about is that if you think about what a loss is, it's actually pretty complicated. Loss does not mean that the customer stops paying you, because even if a customer stops paying you today, they might start paying you in the future. So you cannot just say, oh, loss is when, for example, a customer goes delinquent or stops paying me. No, a loss needs to be when you say, okay, eventually, this money, I will never ever get it back. There's no future recovery. So in the loss, you need to have subtracted off all of the recoveries. And this is quite complex, that you would both have, the customer needs to stop paying me, but then I need to figure out what amount I will get in recovery. It's pretty messy to do all of these things at once. So what we will also try to do is that we will want to determine, what is the pool of these bad loans. And then on these bad loans, we need to determine the recoveries. So it would be much better to divide this into pieces to better understand the problem, which is exactly where we are going now. And so I started talking about the first concept, that you need to identify which are these bad loans. So, you have a pool of loans today, they're all good. What you need to find out is, first, what is the probability that a loan goes bad on you? Because if it doesn't go bad on you, you will not take any losses and the ECL will be 0. So you need to determine this probability of the loan going bad. And then we will later look at, if it goes bad, what happens then? So we need to really define this concept of bad. Like I've talked about it quite heuristically, how to think about it. So if you, for example, often a reasonable way to start from is delinquency. Once I talked to a Saudi bank and they said, oh, we have some customers that are 1,000 days delinquent, but we think they will pay me soon. Yeah, these customers are, they're pretty, that's probably pretty bad. That probably should be classified as, a problematic customer. On the other hand, we also have a lot of customers that might be 1 day late. There might be some problem with the payment system. There might be just some little bit of thing. Like 1 day would be way too early. So, somewhere between 1 day and 1,000 days is where we can really say, a customer really have trouble for real. And a common backstop that is being used is to use 90 days. Now, 90 days, you can say, why is 90 days reasonable? Well, 90 days is a pretty good measure because, after all, 90 days is 3 months. And sometimes I have people I discuss with and they say, no, but I mean, in our case, it's not weird that the customer is 90 days late and then they stop paying or start paying us. But then I often counter back, okay, but they are 90 days late. Like, what attempt did you do to contact them? You had 3 months to contact the customer and really check out what is going on. It's pretty, if you have not gotten any money from 3 months, if you don't know anything about the customer, this customer probably is pretty distressed. So this is a little bit where the 90 days come from. But remember that it's also supposed to be a backstop. So what a good example is if you do corporate lending. So let's say you do corporate lending and the corporate have paid you. And a few weeks later, the corporation goes into default. So let's say that they also do quarterly payments just for simplicity. So they do quarterly payments, they've just paid you. A few weeks later, they go into default or they go into bankruptcy. And, there's nothing left. The company is empty. You will not be paid in let's say 2 months or something like that, where the next coupon is to be due. That's not going to come. And sure, you can wait 2 months and then you can wait another 3 months for them to go 90 DPD until you set them in default. But you already know today that, they are toast. They are in serious problem. And sure, you might eventually get something from the estate when they try to restructure something, but that's far into the future from now. So really, you should, in this case, already place them now in default. And we often call these concepts unlikeliness to pay indicators. Is there an indicator that the company or the individual might really be unable to pay? So Then, we have then this default concept, and typically you should also try to align the default concept with it. So what IFRS 9 says is that you should align your default concept within the corporation, so that you should not really have one default concept for capital and one default concept for credit origination and one default concept for risk management and one concept for your IFRS 9 solution. You should really try to have a consistent risk management default definition that you then consistently use. And it's also good business practice, because I can tell you that if you have multiple default definitions within the company, it's going to be incredibly confusing for the business line that maybe not work with credit risk so much to understand what is going on there. So we now have identified the concept of default, and I show here actually an example. It's actually not only companies or individuals that can default, but you can even have whole countries that default on their payments. And in 2021, the left picture shows projections on what was the default risk, so the probability of default, the probability that 1 year late, within 1 year, there will be a default event for different countries. And Sri Lanka at the time had 27.9% probability of defaulting, and actually within 1 year, as you can see from the right picture, there were a default at the time within Sri Lanka. Now I have heard that they are doing much better now, but it's a good illustration of this principle of default. So the first part, we want to identify this probability of default because we want to identify what is the bad book. The second thing we want to work with is the exposure. So what we mean by exposure is really to say, like, look, I mean, the company, or the person or whoever lent out to, they've gone bad. Okay, how exposed are we now if they have gone bad? And basically, what is the maximum loss that we can take if we get no recovery at all? This is what we call exposure at default. Now, exposure at default actually is, you can say, oh, but that's not so hard to figure out, and like I look at, if you just take, for example, the balance of the loan. I mean, that is my exposure. Well, it turns out, and I have a whole separate presentation about this topic, so you can talk for like an hour on this topic as well, which we've unfortunately were not able to do. But if you think about it, for most customers, you really do expect them to give you some money before they default. I mean, most of your customers should not default on their first payment. Or if you do that, I think you have a problem in your business model. So most of your customers, you actually expect to get back some money before they default. And if you get back some money, your exposure is actually smaller than your balance, because you're actually going to get some money before they default on you. So what you really have to do is that in practice, you have to run a forecast, and you have to first use your PD model. And you not only need to determine what is the probability that the customer default, but you also need to figure out what is the probability that you default month 1, what is the probability that they default month 2, month 3, month 4, 5, 6, 7, all the way up until their contractual maturity. So you basically get sort of, a probability, a number of probabilities. And if you divide it by the total PD, you now will get the weight. So you will get, okay, what proportion of the default takes place month 1? What proportion of default takes place month 2, 3, 4, 5, 6, and 7, and so on. And now you can look at, if the customer default on me month 1, how much is the balance of the loan at? If they default on month 2, what is the balance of the loan? Month 3, 4, 5, and then you determine. So you have to make a conditional forecast. You basically have to make a forecast when you condition on if the loan survives up until time T and then default, what is then the exposure there? But even that is not enough, because you also have to bring in the discounting factor. And why is that? Well, let me give you a simple example. Assume we have a loan that only have one single payment, and that payment takes place after a year, and they have to pay us 5% of interest. So you give out 100 as a loan amount, and then 1 year later, the customer is due to pay you back 105. So if you think about it now, what is the amount that the customer is due on if they now default on you? Well, they are due 105, because 105 is what they owe you. But it then becomes weird to say, okay, so my exposure is 105, but I only gave out a loan of 100. So is my exposure larger than the loan amount I really gave the customer? That feels really weird. I mean, it feels weird that you should lose more than you gave out. After all, I mean, what you lose there is really the compensation for the risk. I mean, that's why it's 105 and it's already time has passed. This is why we need also to discount, because what we need to do is we need to determine this 105, what was it in present day's value? And I mean, if you discount, the discount rate is going to be 5%, and you discount it back, it's 100. Sure, that's reasonable because you didn't get any payments, so your exposure was 100%. But imagine that the customer were given you a payment, then actually it would mean that, you know, the balance would actually be typically sort of smaller, and then when you discount it, it would be even smaller. And if you can have, for example, a good example is that you can have a lot of corporate bonds where, you know, you would say, oh, the company, they don't pay back the principal, they only pay me interest. Yeah, but then if they default on you and they have made a number of interest payments, actually, because the EAD has stayed flat, or this EAD, conditional EAD has stayed flat, you know, but that means that they have made you a number of payments. That means that you can also view it as these payments have been used to lower the nominal of the loan and pay back some of the principal. And that means that your exposure is actually smaller. So it's quite common to see that people just say, no, EID, it's just how much the loan balance is. But you see here that you really need to determine you need to use your PD model. You need to forecast what is the probability to default each of the future months. Either you do 12 months if you are in stage 1, or you do lifetime if you're in stage 2. We will come to staging a little bit later. And then you need to look at, you know, the forecast of what the EID is, and you need to discount it. And I have shown here, just for example, when Russia did their invasion of Ukraine, you had a number of banks that have lent out quite a lot, that then, you know, all of these loans were effectively in default. So it showed sort of their exposure. So we now move on to, you know, the final stage here, which is that if you think about it now, we can think about it almost in how the loan cycle happens. What happens is that a company or a customer will go into default. And if they go into default, we have a certain exposure. And now we sit with this exposure. And the key question is, how much will we be able to recover? And this proportion, how much are you able to recover? What percentage are you able to recover? This we call the loss given default, or the LGD. So here, I hope that you see now why we get this model, the PD, the EAD, and the LGD model, because the PD tells us what is the good book versus the bad book. The EAD tells you if there is a default, what is my exposure? Ergo, how much money have I not been paid back? So it's not just the balance, it's how much money sort of remains still in the system when the default happens. And finally, the loss given default, it tells me, okay, what proportion of the money am I unable to recover back upon? And these three parameters, they were already well known, and you had them in the IRB standard, and they often called the Basel parameters. Now it's important to notice that, you know, the IRB PD, EAD, LGD is something different than the IFRS 9 PD, EAD, LGD. But it's still IRB where it sort of comes from, even though the interpretations and the exact values are different for the PD, EAD, and LGD in an IFRS 9 context. But it's still sort of the origin of this way, because it's important to say that neither PD, nor EAD, nor LGD is mentioned in the IFRS 9 standards. IFRS 9 talks a little bit about risk of default. So effectively, they are talking about the PD, but they're talking about it somewhat informally, and they even stated that you don't strictly need to use probabilities. But I would say, you know, if you don't use this model, you often quickly get into much more complexities. Most of the auditors only see it on this way. Most of the regulators never see something else than this. So this is really the form that you have to use. But it's not because the accounting standard requires it, because there's already such a strong risk practice around PD, EAD, and LGD. And now we have sort of set up sort of, you know, the whole system here. And one sort of, a little bit of a fun way of showing, how you can think about these different parameters is that, you can plot the PD on one axis and you can plot sort of the EAD and LGD on sort of one axis. And then you can say, so let's, for example, say that, the probability is low, the probability of default is low, and you also have that, the impact is low as well. I mean, these would be sort of, your prime, everyday, small, good retail customers. You can then say that, let's say that we instead look at customers where, the PD is actually pretty high. But on the other hand, it's still sort of, a small exposure. I mean, a good example of this is, for example, subprime customers. So if you, for example, do mortgage lending to quite risky customers, as long as the property is still worth quite a lot, you're not taking so large risk. Now, of course, there is an inherent risk in itself, because if you have estimated LGD and the LGD then changes, let's say that suddenly, for example, property prices fall, then the LGD might become much larger because the collateral doesn't cover as much. Effectively, this is what a lot of US banks did as their mistake during the financial crisis. Like, what they saw was property prices keep going up. So even if someone default, that's not a problem, because I get a house that is worth more than the loan. I sell the house, I recover my investment. Okay, that only worked as long as the housing market kept increasing. But instead, when the housing market crashed, suddenly the houses became worth less than the loans, and you started taking quite material losses. So you should always be, in this category where you take a high PD and you say, no, that's fine because I have good collateral. Yeah, is the collateral good right now, or will it be good when you really have to go and collect on it? In the upper corner, we will have, so, the one with low PD and high EAD and LGD. It really shows, the single, when we have sort of, maybe very safe customers, but we could actually be quite risky. A good example here is something like a government bond. I mean, government bonds are very low risk. I mean, the PD is very, very low, but it's actually not so clear, like what legal ability you have to recover on them if a company were, or if a country were to default on their debt. In particular, if they have denominated the debt in their own currency, then it might be that they just declare, they just inflate it away. They might declare sort of, that your bond effectively become worthless. So here it's almost this sort of, single concentration one. And then finally, sort of high PD, high EAD, LGD. I mean, this is typically sort of high risk that you are not sort of willing to take.
So Jacob, maybe we'll take a little bit of intermission and get into the interaction in the chat.
I mean, that's an excellent point to do so. You see that I've a little bit thought this in now before we go. So, thank you so much for interrupting here.
Okay. So there was an interesting discussion on the charts about the parameters. I know you have just talked about it a few minutes ago. The collateral, the value, or rather the function of the collateral into the in the calculation of ECL, particularly the LGD. In developing countries, including my own with Tanzania, in banking system and even microfinances, you can't take a loan without having a collateral which is of equal value to that loan. So how do they affect the value of the LGD when you're doing the actual calculation? And a number of contributors here, Ahmed and Nino, pointed out that the type of the collateral and the quality of collateral has a direct effect on the calculation of ECL. What do you think about that?
Super good points raised up, and really important questions. I will start with a little bit of an example, and I hope that will illustrate some of the points I will make here. So I once gave basically a version of this presentation to a Pakistani audience, and there was a guy there from a Pakistani bank, and he said, oh yes, we give out quite a lot of loans to farmers to buy goats. So the farmer, he buys goats, and the goats are collateral for the loan. And, the goats have to be of, equal value to the loan, as you said here. So, you can feel that, oh, this is a pretty good business model. But what we have noticed is that if the farmer doesn't pay us, and we have to go and foreclose on the farmer, and we have to take the goats because the farmer have struggled financially. The farmers might not have had money to pay for medicine for the goats. He might not have food for the goats. So what we get is very, very malnourished goats, and they are not feeling well, and their value is actually very low. So even though on paper we had equal value of the collateral to the loan, actually, whenever we foreclose on someone, we actually take a pretty sizable loss because the collateral value is lower. And my point here is that you actually see, for example, similar in the mortgage market here in the Nordics as well. So it's not uncommon. If I lend to a property, the property looks a very nice property, and some people buy it, and they get, for example, here in Sweden, you can get an LTV of 90% at most. So then you might say, oh, we are pretty golden here. Look, I mean, the collateral is worth almost like 10% more than the loan that they take. Okay, so we're gonna have no problem because the property market is not gonna go down by 10%. I mean, that's completely unfathomable. And then when you have to foreclose on someone and you come in and you check the property, what you might discover is that they started renovating the property and they ran out of money, and you come down into the basement and the basement looks like total crap. And there are wires hanging from the roof, and the house is in terrible shape. And of course, when you go out now and sell the house, you're going to sell that for much less than what you really thought that it was worth, and that means that you're going to take some real losses. And it ties back to this. You talked about the concept of sort of collateral of equal value. When we talk about the value of collateral, what is the value we are talking about? And I think a common mistake we make as bankers is that we too much tend to focus on the current fair value of the collateral. You have a house right now. What could you sell that on an organized market? You have these goats now. What could you sell the goats for right now? That's not the question you should be asking yourself. Sure, we might have some regulatory requirements on LTV and so on, and for these reasons, it might be pretty nice to calculate with fair value. But remember, if everything goes well, you will never ever have to think about the value of either the goats or the house, because if everything goes well, it's the customer's going to keep the house. But it's only when things go bad that the value of the collateral matter, and that might be when the value is also distressed. So when you do LGD calculations, and when you include your calculator LGD, you really need to think about distressed valuation. So you need to think about, could it be so that when I go and I foreclose, that also the collateral could be in worse shape than I thought normal? And this is really important to think, because this could be a channel where you can make quite some losses on, because you have only thought about, you lent and it was sort of, nice weather, and you said, oh yes, I lend to this beautiful house, it is valued at this very high price, great. And then when you go and foreclose on the person, that might be the moment where you discover that there is actual issues, and the house might have deteriorated and so on, because there can be a fair amount of correlation between that someone defaulting might also not really be taking care of their house. So sometimes a simple solution for this is that we introduce, for example, haircuts and so on. But you can also, collect the data. Is really the best recommendation, where you have done distressed sales and you look at what did you sell things for, and you compare that with what the value was, that the sort of normal fair value, and that's really sort of something that you need to bring into your LGD calculation.
Yeah, so in short, you're telling us that there is no one method cures it all. At the end of the day, ECL is forward looking, so you are not sure that if the value of collateral would remain the same up until the end of that loan, or at the time that you actually need the collateral.
Yes. But what I'm saying is more like, don't forget that when it comes to LGD and it comes to collateral, what you're concerned with is what is the value of the collateral in a distressed situation. That's really what should concern you, and that's really what you should bring, the mentality. Similar with cars. I mean, okay, don't think about what is the value of the car right now. Think about what is the value of the car from someone unable to pay their loans. Is that a person who takes care of their cars? Is that a person who have made sure that the car is in prime shape? Probably not. this is the reason why you have to calculate these haircuts on the collateral value. And you know, the best way to do that is to try to collect data on this and really include this factor. But otherwise, at least use some sort of haircut multiples on the value of the collateral.
Okay. I hope that clears some of the air. And there's another question before we go. You go on with your presentation from, my apologies if I don't mention it as it's supposed to be, Note Dahlstrom. And Note is asking, how is EAD for credit facilities calculated? I'm assuming this is for microfinances and the like, microfinance and banks. How is EAD calculated for these facilities?
I will actually come back to that. I will save that question because I have a slide later on where I talk about that, and I actually want to devote some time. So I promise to. This is not a cop out for me. I really wanted, because this is a really great question, and it is one of the good examples where I would argue that the IRB and IFRS 9 standard is quite different from each other. So really good that the question come up. But let's come back to it in just a little bit of a while. Because what's now going to happen in the presentation is that we're going to start looking at each of the parameters and look at how you estimate them. Did we have anything else interesting in the chat?
Yeah, I don't think so. There's a question about FRM. This is a professional exam for financial risk management, the concept of correlation breakdown. I guess this is a general question and not related specifically for...
but then we can come back to it.
Yes, we can come back to the presentation.
Okay, but really great questions. Really great questions so far. So okay, now we move into the next phase, which is let's look now at the parameters. We have set the scene, we have the PD, we have the EAD, we have the LGD. Now let's deep into how can you do the PD modeling. So first and foremost, if I go a little bit if I go a little bit back in history. We are all different countries here. Some of you guys have worked with IFRS 9 for a really long time. Some of you guys have just now started to enter IFRS 9. Some of you have not even entered IFRS 9 yet. But I can tell myself from experience that when IFRS 9 came, it was quite a shock here in Europe. And a lot of institutions were not really ready for it. And it was very rushed in many institutions. I mean, the irony was we were we had quite a lot of time because the standard came in 2014 and they weren't supposed to apply until 2018. So if you started and you did your homework like you were supposed to do, no problem. The issue was that many institutions didn't do this. They waited, and then they had to rush everything. So first generation of IFRS 9 models were very focused on thinking about sort of binary questions, because if you do loan origination, for example, you are to give a loan to a customer, and then what is quite common to do is that what you basically say, okay, I mean, either this customer defaults or it doesn't default. So it's a very binary thing, and you might have, for example, you might take an 18-month window or a 12-month window forward. So you say 12 months of the default, have the customer defaulted or not. Very common methodology. Similar in the IRB, because many banks here in Europe, especially the larger banks, were IRB certified. So this, capital model standard. But also in IRB, you focus on a 12-month window. You say, will there be a default within 12 months? Yes or no? Binary question. And for binary questions, logistic regression is sort of the real workhorse. And it's often called, you often call these scoring models and so on. I would argue fundamentally that scoring models and these logistic regression models are not really appropriate for IFRS 9. And we will see a little bit why, but the key problem is that if you use these type of models in IFRS 9, you will have to do quite a lot of additional work. Because if we think back a little bit, when I talked about the EAD, I pointed out that you don't only need to know if a customer default or not. It's not just a binary thing. You need to know when they default, and this really matters. Imagine, I sometimes take a very extreme example. There is one loan that was given out back in the 1600s in the Netherlands. They wanted to build a flood wall protection, so they wanted to protect themselves from the floods. So they gave out a loan which was perpetual. So it would pay a coupon every month, every year, 5% forever. that they have been paying that loan now for over 300 years. Now imagine that the customer, imagine that you sit as the risk manager, they come to you, these people from the Netherlands, and they want to borrow money from you. And you say, when you calculate your EAD, you say, okay, what if they default on me the first month or they default on me after 300 years? I mean, obviously there's going to be a huge difference between these two scenarios. In both cases, they owe you 105 because they owe you 100 principal plus 5 the interest. But in the first case, you have gotten no money at all from them. And in the second case, you have gotten, thousands of money because you were able to get all the interest payments. So of course, in the second case, there's very little of the loan actually effectively remaining. And, you have very good credit protection. And in the first case, you have not so much. And this really matters because it means that when you build a PD model, you not only need to figure out yes or no, will it default? You need to figure out when will it default? If it default, when will it default? Because it matters for the size of the exposure that you will get. And that really, as we say, that really matters. So what you really need, as we say here, you not only need the PD, you also need a time series. You need to figure out what is the probability of default the first month, the second month, third month, 4 months, fifth month, and so on. And you also need to be able to build sort of, a quite sort of, model that can do some updates and similar. You want to also be able to extrapolate sort of, long-term behavior. And what you also would like to know is, and here is also another important thing, sometimes when we talk about, let's say that you do a window, for example, of 18 months. Sometimes you see that people just look at the end of the window and they say, I check after 18 months has the customer defaulted or not, or after 12 months have they defaulted or not, and that's what I determine. But IFRS 9 tells you that what you have to look at is that you need to look at, is there any default within the period? Because from a PD point of view, what you care about is there any default at all? And as I show here in the picture, it's not the same thing to have a customer paying every month, to have a customer paying, defaulting, curing, and then paying again. These are different from a PD perspective. And the PD is different because in one of them you have a default and in the other you have not. And it will matter when we look at significant increase in credit default or significant increase in credit because it is dependent on the PD and not on the other parameters. So you need you need something that really have a more of a longer perspective compared to just looking at this binary question. And one very nice tool that I myself often tend to advocate, I mean, there are many models, but one very nice model to deal with this is the hazard model. So the hazard model, it focuses on the intensity of risk. So what it really means is that per unit time, what is the risk that the customer will default on you? So you really are thinking about, almost like a pool of loans, and you're thinking a survival perspective, and you say, what is the probability that you keep surviving each small little incremental unit? And what you then look at is how this hazard changes over time. And it's often this hazard, it has to be positive because there's always a positive risk. So one way to be able to mathematically model it quite convenient is that we look at the log hazard, because the logarithm of a positive number is a real number. So then you will have this z, the log hazard, and you can write then, what you do then is that you calculate this integral. So e to the power of z, e to the power of zeta, then over time. So this you call the hazard model. And the hazard is also a very nice scale to use. So what you can do is that you can transform to use the hazard scale is often much better because the problem with PDs is that if you, for example, plot PD on the x-axis, most of your loans will be very low PD. So it will only be a small part of the axis, while the large part of the axis will be made up of these very high risk loans. But the log hazard scale is quite nice because -10 here would represent half a basis point. That is typically almost as low as you can estimate risk. This is incredibly low risk. So a basis point here, just for those who doesn't know, a basis point is 0.01%. So this is half of 0.01% if you have 0.45 basis points. And on the other hand, so it's a good example just to get a good reference is that around 0.3% or somewhere like that is typically what we tend to view as investment grades. So that would typically be around 30 basis points. So, that's also a way of thinking about it, that, if 30 basis point is investment grade, 0.45 basis points would be incredibly small. But then if you go all the way to log hazard equal to 0, then you have a PD of 63%. That is quite massive. You could, of course, continue to scale. You could have something that's smaller than -10 in log hazard and something that's greater than 0. But it's a very nice scale. I actually have this at my desk. I have like a log hazard scale, because I often think about risk in this sort of scale, and moving, 1 unit in this scale is often a pretty reasonable way to think about sort of notches in risk and so on. And what you can do is that you can do what you often call the weight of evidence model. So the idea is that, you will have, when you build your model, you will need to have multiple different variables, typically. And you might then say, okay, so how should I put the variables together? One very nice approach is that what you do is that you build multiple models. So what you do is you take each variable in isolation. Let's say that you have, for example, days delinquent, and you have another variable that is utilization of, for example, a credit line and so on. So you have a list of different variables. And then the idea would be to say, look, I analyze each variable independently. I build the best model I can. I build this sort of survival model and with this log hazard model for each of the different variables. And then I say, okay, now I have basically built the best possible model with one variable and with another variable and another variable. Now, can I combine these models and build one really nice joint model? And this is what you often call the weight of evidence score. So what you do is that you do a pre-processing, you determine each individual model, and then you weight these models together with these weights, and then you determine the weights empirically. And this method is quite nice. There are many other ways that you can do things, but it's a quite nice method because it means that you can look at each variable independently and really think about it. And I used to sit as a model validator, and I can say I really appreciate when modelers would come with this, because they could show me one variable and we could talk about it and how it behaves. And they would come with one variable and we could talk about it and how it behaves and so on. So when we aggregated together things, it wasn't really so complicated. Then we would just basically weight the models together and take sort of, the best of all these worlds. And the weights then tell you basically how important are the different variables compared to each other. So sort of highest weights will be the most important variable and lowest weight would be less important variables. And this is, again, a pretty nice way of sort of making it interpretable. I can also tell you that, if you run IFRS 9 models in production, what often will matter is that, suddenly 1 month, PD spikes. It goes up, ECL goes up, your CFO comes running, down through the floors, and he says, okay, tell me what's going on? Why is suddenly this going up? I need an answer now. And when you work with IFRS 9, I think those of you who work with it knows that, time is of the essence. It's common that you will get, your data to calculate on maybe first or second day of the month. Fourth day, maybe even fourth day before lunch, CFO wants to book the numbers in. There is no time to wait. You need to very quickly determine, is there a problem in the data? Is there some new trend going on? What's really going on? And then having built the model in this way, where you have these sub-models that you have weighted together, is very convenient, because you can then very quickly run each of the sub-models and check, what is the score for each of the variables. And if you see some of them that stands out, okay, look, let's deep dive into that variable. What's going on? Interpretability, we often talk about this, in modeling. How should we prioritize interpretability with accuracy? I often say modularity is underestimated. Modularity is this idea that I can very quickly break things into pieces, check each of the pieces, and then determine which is the faulty component and go from there. And this is really why this sort of, weighting model works quite nicely. Let's see. Yes. Another thing I really want to talk about is customer segregation, because you can also ask yourself a little bit about, okay, which which type of group, how you should sort of, segregate your model. At the end of the day, there's always a balance. If you put all customers together in one big, huge model, that's not really going to often be that good, because customer might be very, very different from each other. And I used to work in the unsecured lending industry before I worked for my current bank. And there we would have two different channels basically that you could get into the bank. So either you could come directly to us in the bank, and you, for example, either called us up or went to the web and said, I would like to apply for a loan. These customers that came to us directly, they were often pretty good quality, because they had made the due diligence and they'd said, this is the bank I would like to go here. But we also had a lot of loan brokers. So a loan broker is basically an aggregator. So you as a customer go to the loan broker. Loan brokers will send out offers to many banks, and then the winner bank will be the ones who offer the lowest interest rates. And what we noticed was that the loan broker customers were often of much lower quality. And the reason for this was often that these guys were, they were much more sort of, out there in the market trying to find sort of loans. They were much more sort of, risk taking. And, since these customers were so different, you could argue, sure, you could have put everything together, but we had quite a lot of good data on both of these groups, and then it really made sense to make it into different models. And this is really my advice. Sure, you should not build, a billion models, but you should really be careful on putting together groups where the business treat them differently. And often, sometimes I often get this sort of, the people say, oh, how do I know which model, how to segment? And I say, the absolute best way to know how to segment is to go into your credit department and ask, how are you seeing difference between customers? Because in this case, there was a whole different departments that dealt with these two sets of customers, because people said, oh, the customer that came to us, the D2C customers, oh, they are so different from these broker customers. Yeah, sure. But if we know that as a business, we probably should have them in separate models. Another thing that really matters, and that's I talk about, is the delinquency behavior. Because if you look at, for a behavioral model, what is the most predictive variable? Typically, the most predictive variable is how delinquent is the customer. If you have customers that are delinquent, more or less the only question that matters is how delinquent are they? Most of the explanatory power can more or less be explained by the number of days delinquent. Are they 30 days delinquent? Are they 60 days delinquent? Are they 70 days delinquent? Okay, they are about to fall over the edge now, because remember, 90 days delinquent and they are toast. They go into default. So then the goal here would be that delinquency days gives you quite a lot of information. Now imagine that the customer up to date. Okay, then days delinquency is 0. So is all customers up to date the same? No, they're not, because typically delinquency information matter here as well, but it matters in a very, very different way, because what matters is how delinquent have customers been in the past. So were they delinquent last month? Were they delinquent 3 months ago? Were they delinquent 12 months ago? Have they been delinquent multiple times the past 12 months? These are pretty important questions to ask, because it, again, is a very, very predictive variable. So for customers up to date, past delinquencies is also a very predictive variable. Now notice the difference. So if I put these two groups, the delinquent customers and the non-delinquent customers, if I put them in the same model, I will put a lot of emphasis on being delinquent or not delinquent and how many days delinquent. Oh, that's a really important variable. Yeah, but that variable tells you 0 for the groups that are not delinquent. And it means that it's much harder then to group these two together. And if you have the data, it might make sense to have different models for delinquent and non-delinquent customers. Now, if you look at non-delinquent customers, I said to you, past delinquencies, okay, that's really informative. Yeah, but okay, what if you have customers that have either never been delinquent, or at least they were delinquent really, really long time ago? Okay, so, are all of these customers identical? No, they're not identical. They also are different. But here here it's much harder. Here we have to often look at a lot of indirect information. We have to look at things like utilizations. We can also look at what did we originate the customers at? So at what risk level, at what PD level did we originate them? Because when we brought the customer into the bank, we typically made a PD assessment there as well. And you can use that PD as the starting point for the PD to use when they're within your bank. Because after all, day one, the starting PD that you had when you originate the origination PD should be the IFRS 9 PD if they have the same definitions when you start off the system. So, and this consistency means that, it might make sense to actually have different models for, currently delinquent, past delinquents, never delinquent customers. I'm not saying that makes sense in every bank. It depends on how much data you have. But I think it's really valuable to distinguish between, what variables should I use and are these variables relevant for all groups? And if they're not valuable for all groups, maybe these groups needs to be dealt with separately. And again, I think it really makes sense to look at how you deal with it in the business. Another thing that is really valuable to think about is the combination of the question of attrition. So especially if we talk fintechs and these sort of businesses, what you tend to see is that that for a fintech, typically customers leave pretty quickly. You might have a quick high turnover of customers. Same thing can you have for certain products in an ordinary bank. So default is actually not the only way that the customer can leave you. They can actually leave you by basically closing down their position. Now, in that sense, from a risk point of view, that's pretty nice. Sure, that's not good from a business point of view, but at least that lowers the losses for us. But attrition is important to bring into calculation because if you think about it, attrition lowers the PD. Because if the customer closes on you, they will not default on you. And sure, you can say, no, but I don't need to make an explicit attrition model, because if I just take the PD history and I just look at where they're lost and where they're not the loss, and if the customer attrite on me, I will not see a loss number. So, then I don't need to bring it in. Yeah, but there is a real value in including attrition explicitly for sort of two reasons. One reason is that it's important for you to understand, is the PD low because the customers are really low-risk customers? Or is the PD low because the customer keeps leaving you before you see the problem? And I can tell you an example. I used to work with lending in Norway. And in Norway, for a long time, they had a very, very aggressive loan market. So what happened was that the customer would be with one bank and they would take a 15-year loan. And then they would stay 12 months, sometimes even shorter, and then they would take a loan in another bank. So they would move the loan. So they would move the loan back and forth, back and forth, back and forth, and eventually they might default. But if they move it back and forth, back and forth, back and forth, and most of your customers keep doing that, most of your customers would look like they never default on you. So actually the customer looked pretty safe. And it was, you gave them pretty good prices because, I will take very little losses because, it's a little bit like a hot potato. I will always be able to, it will leave my balance sheet before the bomb explodes. I will just have them for a little bit of time and they will pay me some good interest. Yeah, but then in Norway, they passed a law that made it much harder to move between banks. Basically, the banks were required to give the customer an equal or better offer than they had at another bank, at the previous bank, in order to be allowed to move. So suddenly, the customer froze in place. They did not move anymore. And suddenly, a lot of the banks realized that now these were high-risk credits. And the default rate just skyrocketed, like you would not believe it. And had more of these banks separated attrition and default from each other, then what you could have done is to say, look, I know that we're about to get into points where attrition is going to go down. Let me crank down the attrition and say, oh shit, these are actually pretty risky customers if I look at just the raw PD component. So separating attrition and default is actually pretty important. And there's also a third factor I think is quite valuable to separate as well, and that is if you have a customer that that dies for real. So we also talk about life death processes when you talk about default, but you can really have, of course, always tragic when customers pass away due to high age or something like that. And these customers actually, the estate then takes over the debt. And that behaves actually quite differently. So you then have, often in your systems, and it's really good. This is, I would say, if you work out in a bank, a good exercise is go and check, how is this recorded in your system? Is this recorded like, for example, a default? Because if it is, it might really obscure your statistics, especially on low risk portfolios where you might have quite few normal credit defaults, but you will always have one or two customers that keep dying on you. Because these are, of course, driven by very different factors. I mean, the death is not driven by credit risk. So it's also good to separate it out from that perspective. These estates are also more complex because at the end of the day, you can ask, is this an attrition or is it a default? And it can almost be a little bit of in between. If you operate in a more low risk industry, I would say, if you operate like mortgage industry, typically, a death, it behaves much more like a attrition event. It's basically just the customer terminating early on you. But if you operate in a pretty risky industry, it can be much more like a default event. But the reason is that if you have, for example, an unsecured loan, the estate might not have too many assets, and the estate might be unable to pay you. So, again, it's important to check, how material is it and what typically happens. Does it make sense to put it in the pile of the defaults? Make it sense to put it in pile of attrition, or should you rather, treat it as a separate category? Also, it was already mentioned here before, this concept about forward-looking information. I have a whole presentation on its own that talks about, doing scenarios, and you can talk a lot about that. I think this is a really, really fascinating topic. I sometimes also think this is a quite misunderstood topic when it comes to forward-lookingness. Because forward-looking, often people spend a really, really lot of time and say, I need to build really advanced macro models and so on. I would say the most important thing when it comes to forward-lookingness is to avoid being too backward-looking. So if you think about, for example, let's say that you build your models and you take, some data set and you are really proud of yourself. You spend a lot of time, you built this very nice model, used 5 years of data, and you put the model in production and you let it run. And it runs year in and year out, and you're very happy about it and you understand it. Sure, but if you just let the model run forever and you never sort of recalibrate it or change it or anything, the model might drift away from reality. And this is a lot what forward-lookingness is about. It's basically about that you cannot be overly reliant on backward data, but you really have to think about, what is going to happen in the future. And a lot of the future you can learn from just looking at it right now. But of course, what you also would want to reflect is, let's say that you've had data that you've collected in a low risk period. What you would like to do is that you would like to say, okay, if I think actually there's going to be a high risk period incoming, that should probably be reflected already now in my losses. And I go back to the original example I gave on the bond trader that, you had your portfolio bonds that were traded in the market. I mean, if the world goes into a worse state, the value of these bonds are going to go down right away, and you are supposed to reflect the same thing in your ECL model. This is why you need the forward-looking information. Also, another thing I can say is that imagine that you run a pretty low-risk credit market. So you give out, for example, mortgages, and there's not so much risk in these mortgages. You're pretty low, LTVs. They are very good customers. So then you might say, no, but I'm not going to take a loss. My LTV is, for example, 40%. So the loan to value is 40%. I mean, even if the house is in worse quality, and even if the property market goes down, I'm not going to lose that. Yeah, but that's why we need scenarios, because you then basically need to include at least one scenario that is so bad that you actually take some form of losses. So scenarios and using multiple scenarios and weighting together also matter, because you need to properly reflect the full probability distribution. And this is why we use the scenario analysis. It is to have wide enough scenarios so that we see the full losses, but also the full upside of the portfolio. And as I said, this is a whole talk on itself. If someone is more interested in learning about this, feel free to ping me on LinkedIn and similar. Happy to send you, as I said, I have a whole presentation on just this topic alone, and how you can do weight calculations and so on. So it's a whole chapter in itself. But if we now take a little bit of a step back, okay, what have we been able to do here? We have this, competing risk model where we look at, the default risk, the attrition risk, and this sort of, death of natural causes. And what we also do typically is that we then, look at, the probability part comes from taking the default contribution, and also we include some of these deaths that lead to actual defaults. And the PD then comes from integrating this profile. Now, in practice, you tend to have that, you deal with things on a monthly level, so you approximate this integral with a sum instead. But this is, I would argue, a pretty nice framework to operate in. There are, of course, other frameworks. You can use, for example, transition matrices and so on. But I would argue that they are often a little bit, they make too strong of theoretical assumptions. So I myself is pretty fond of these survival models. And I would also argue that it often mirrors a lot. If you go to your business analytics people, you can often see that they draw these sort of, cumulative vintage curves and so on. So it tends to mirror quite a lot of what the business is actually already doing. And the nice part with this model is that we will get both the overall PD and we will also get the timing of the default. We will get an estimate on where are the defaults taking place, just as we need it. So we move on to exposure at default. And the first part, when it comes to loans, that's pretty straightforward. What you typically do is that you tend to make what we call the sudden default approximation. So you basically assume that the customer keeps paying you, and then 3 months before the default, they just stop paying you, and that's really what you do your calculation. So when you forecast your EAD, you say, okay, remember, you always condition on the time of default, because this is what you got previously. If we look, back in the previous slide, you get this, monthly default probability. So when you do the EAD, you condition on and say, okay, I now want to calculate an EAD based on that they will default on me month 12 from now. Okay, if the customer is currently up to date on you, that means that they need to stop paying you month 9, because then they have month 9, 10, 11, and then the 12 months if they fall over, or a little bit how you set up your counting. But then it's quite easy for you. You calculate, the healthy months, the customer pays you, and then once they stop paying you, you instead just accrue interest on it, and then you discount everything back. So not really that now some people have sometimes say, no, but what if the customer have been they go delinquent somewhere in the middle period, and then they are delinquent, and then they start paying you back, and so on. Sure, I mean, that can absolutely happen, but it turns out in practice that it isn't really so much of a problem. Another thing sometimes people bring up is, what about over amortization? So we are not talking about attrition here. We talked about attrition previously. We're talking about customers that, they're still on your books, but they just paid you back faster than you had expected. They throw in a little bit of extra money. And of course, that's going to lower your exposure. And if you just do this normal contractual calculation, you're not going to reflect that. Is that a problem? In practice, in my experience, happy if someone has some different views here, but in my experience, often this is not so much of an issue, because risky customers, the ones who default on you, tends to be the ones least likely to make these overpayments. So if you think about the ECL, the ECL is very heavily weighted toward bad customers, because it's basically an estimate of bad debts. And most of the bad customers tends to be the ones that are least likely to over amortize. So sure, they can absolutely be a part of your book that over amortize, and it might be quite common, but it will be much more overrepresented on good customers, which get a very low weight in your calculation because they have a low PD. So in practice, I'm not necessarily super concerned. Now we come to the question that was asked, previously, which is about credit facility. And I love that question came up, because credit facilities is really tricky how to deal with, because credit facilities have a current balance and an on balance part, and they have an off balance part. And first and foremost, a really interesting thing about a credit card is that, because I will use credit card as the main example, but you have company revolving facilities and things like that. But effectively, a lot of them works the same way. Now, I mentioned before that, and that when you do IFRS 9 calculation, you should base it on, when you talk about lifetime, you should base it on the contractual lifetime of the instrument. Okay, but if you base it on the contractual lifetime of the instrument, what is the contractual lifetime of a credit card? And I recommend to everyone, go into the term, if you work for a bank, you are a customer with a bank, go into the terms of services and really dig into what it says about your card. In most cases, you will find that the company have reserved language that says that they reserve the right to cut the card and to remove any off-balance exposure at will. With if they perceive that there is some issue or something like that. So from a purely contractual point of view, most banks have the right to instantly terminate the card. So the contractual lifetime is, what is it, like 1 day or something like that. So it would mean that if we just follow the book by the letter, we should really, have a really short horizon on this off-balance component, and it wouldn't really be a problem. ISAB noticed this because it was discussed in the industry at the time, and they said, look, that's not really a faithful representation because most banks would not really cut, functioning cards. They would typically only do that once you're really distressed, and then you're really taking on the exposure. So what they introduced was a special exemption in the rules for revolving facilities, where they say for a revolving facility, you actually don't have any contractual time. You instead more or less have to make your own assessment here. And what you typically do is, one way to view it is that effectively view the credit card as perpetual, or at least whatever maturity time that you might have in your terms of service. But it's quite common that there's actually no real ending time because the company can terminate it at will. I've seen one bank who said, but the lifetime I use in the IFRS 9 is based on the lifetime on the physical plastic card. Yeah, but you will send a replacement card once that time rounds out. So that's not going to fly. But what you can do is that you can basically determine sort of how long. Over how long time do the customer typically stay with you, and over how long time into the future are losses typically taking place, and you make a sort of loss emergence curve, and that's really what you base the time on. And you typically here attrition will, for example, matter. So it's good to. This is also a good example why it's good to do attrition modeling, because you can then use attrition to determine how long the customer stays. But then you might now ask, okay, how to include this off-balance part? And a very common model is to have that you say that the exposure default is equal to the current balance plus a portion of this off balance. The most extreme assumption would be, on one hand, you can say, okay, the customer, they have a credit card of 100,000, they've used 40,000, and they have 60,000 remaining. Okay, the balance is 40,000. I will just assume that they use no more money if they default. Okay, that's pretty aggressive. That's probably not such a good approximation. But on the other hand, you could also say, okay, the customer have 40,000, they have 60,000 remaining. I will always assume they use everything. In the run up to default, they will always spend every single dollar remaining on the card. So I always use 100,000. That's also over conservative, and IFRS 9 tells us to be unbiased. So okay, then a model that's common to see from the IRB is that you say, okay, I will do something in between. I will say, some portion, let's say that this portion is 50%. So the CCF, I set that to 50%. What I will do is I will set that CCF I will then combine it. So I will take 40,000 plus 50% of 60,000, that is, 30,000. So I will use 70,000 then, and this is the CCF. And this is quite common to see that, you estimate these proportions. But from an IRB point of view, this really makes sense. Because if you think about it from an IRB point of view, you already try to be too conservative. So you say, okay, what my exposure will be is my current balance, plus I take some portion of the off balance. But from an IFRS buying point of view, you try to be unbiased. And this model will run you into trouble if you just have the on balance plus CCF times the off balance. Because if you think about this model, the EAD is always equal to or larger than the on balance. But remember what we talked in the previous section. We talked about that the EAD can actually be smaller than the current balance because the customer will pay you back. That's not going to be reflected here. So, what if, and I used to work for a credit card company, so I experienced this quite a lot. It's actually not so uncommon that customers will default on a smaller amount than they currently have. Because sometimes you see that you have customers that have drawn down pretty almost everything, and then they pay you back quite a lot, and then they start drawing back again, and then they default. But if you have this, effectively the customer have gone down in balance. That's not going to be able to be handled if you just have the CCF. Therefore, I argue that you need to add an additional parameter, the CRF, the credit retention factor, to stabilize the regression. So what you really can do is that when you calculate these, you can make a regression between between your actual EAD, your on balance, and your off balance exposure. And then so you have both of these as variables. And then you estimate these regression coefficients. So instead of having one coefficient, the CCF, you really need to have two coefficients. So this is not so often so seen, but I would argue it's not seen so often because people too often don't give enough attention to the fact that IFRS 9 and IRB are quite different from each other to their nature. Okay, we come now to the final parameter, the loss given default. So, we are now in default. Okay, what is next in the estimation? And, then one of the things that's also important to focus on is actually that the EAD might be somewhat different from the customer balance. I think a really good example is if you buy distressed debt, as I mentioned before, or similar that you might have originated loans at discounts or premiums. Because let's say that you have distressed debt that you bought the debt at 10%. Okay, to nominal value. The EAD, that's not going to be 100. That's going to be what you bought the loan for. The EAD is going to be set based on what your balance was to start with, and the balance is based on what your purchase price were to start with. So you have to be a little bit tricky when you originate loans, or when you get loans that do not behave normally and might have these discounts and premiums, because it should really be the original fair value that you start the EAD calculations from. And similar, another favorite example of mine is that if you have these brokers, loan brokers, I mentioned this before, and I show actually one here which have a very Swedish one which is called Lendo, which is pretty dominant when it comes to unsecured lending in the Swedish market. So, they have one bank and they target one other bank and they have 35 more. So when that is the Swedish one, you go to this Lendo, they actually send your offer to multiple ones. Now, Lendo will charge around 5% for this if you get a loan through them. So if I lend out 100,000 to a customer through Lendo, actually it costs me 105,000. And these 5,000, I'm not allowed to just write them off as an immediate cost, because really I was prepared to pay 105 to get the right to the customer's cash flows. So I really need to write the loan balance as 105. But if the customer default on me, I only have the ability to go after the customer's 100. I cannot come to the customer and say, look, because you defaulted me, I need you to pay the fees I paid to this broker. That's not going to fly. So you need to be a little bit careful when you do LGD calculation, because often in LGD, it makes sense to look at LGD as a proportion of balance. But if you then have that the EAD and the balance is different, you actually have to adjust for that. Another thing that you have to be slightly careful about is that you have to distinguish between a PD and LGD. So I used to work something for a previous bank with leasing. And then it was quite common that when we did leasing agreements, we did them with quite large companies. And then some of the risk managers, they would say, the LGD on this agreement, it's very, very low. The LGD is very low because it's a very good customer. It's a very good customer. And they have a lot of collateral and they have a lot of assets. Sure, they're not tied to us specifically, but if they ever were to go default, they would have so much assets that we could sell off. We're always going to get their money back. And I would often say, yeah, but okay, if they have a ton of assets and they're really liquid and they really have a nice business model working, they're not going to go default on you. They're only going to go default on you if they're really bad. So they're only going to go default if things have turned bad. And you have to imagine what that world looked like. It's a bit like the goat example we gave before. If you say, oh, but the farmer will always feed his goats. Yeah, but that's if the farmer have money, and if the farmer have money, it's also going to pay you, and it's not going to default on you. But what if the farmer has no money to pay you? Then he might not also have had no money to pay the goats, and hence the collateral might be of worse quality. Another thing, before you even go to collateral, one important part to consider is really to consider the cure rate, because most of your customers that go default, you might actually be able to get back from the default position and to be able to recover quite a lot from them. Or to get them back into performing loan. And if you get them to a performing loan, I mean, effectively, if they stay performing forever, I mean, things are then pretty good from that perspective. So you actually have to include this when you do the LGD. And one quite common model is that you look at this cure rate, so you will estimate that. And if the customer do not cure back, I mean, then you will have what you sometimes call loss given loss or loss given sale, because basically you will have to go on and try to sell their collateral and so on. But even if they cure, it's important to remember that you still have a loss exposure, because if you have a customer that go into default and the customer cure and then they are out, the customer doesn't have zero risk. I mean, in fact, this customer typically have higher risk than they had to start with. They can default on you again, and you can have multiple defaults, and you can get a risk again. And you have to typically compensate for this. Now, it depends often how risky the portfolio is, if you have to do these corrections. But this is why I've included this loss given cure, LGC. So it's good to, and what you can do is a way to estimate this is that you look in your data and you look at customers that just cured, and you look at what is their ECL divided by their balance. That's a pretty good proxy on, how large is this effect. And then, okay, so we have talked about, the LGD concept, we have talked the PD concept, we talked the LGD concept. We come to, the final part, which is the staging. And remember that, I talked about that, ISAB had this first idea that they would do this discounted cash flow calculation. That, they were ruled out on that. But a nice part of, but it would have been nice for them to keep that method, and we can see now why. And one important thing in accounting is the matching principle. So the matching principle is that expenses should be reported at the same time as revenues are. So there should be this lineup between these two. And if you think about an incurred loss model, so incurred loss model is basically, as we said, that's when you take no losses before they go into default. That violates the matching principle, because as long as the customer keeps paying you, you take in income, and then when they stop paying you, okay, you take all the losses. So you really did not match losses, the expenses with the income. If you take this credit adjusted effective interest rate method, this discounted cash flow, that really works here, because remember that you adjusted the interest rate, the discount factor, you adjusted that for the credit losses, so you actually accrue less interest over time, and you build up sort of a buffer, and basically that buffer is then sort of released if they then were to go into default. So in this case, you fulfill the matching principle. If you take the expected credit loss model and we look at lifetime losses now, that violates the matching principle, but now it's wrong way the other way, because you actually take all of the losses first, because you take a lifetime loss, and then you take all of the income afterwards. So again, you are wrong now on the matching principle, but you're wrong the opposite direction. I saw that there was someone here from US, and you guys work with the CSL. The CSL standard it has no stage 1 and stage 2. It does everything on lifetime. And the plan was originally for FASP and ISAB, the two accounting agencies, to really align on a common standard. But US decided to go their own way and said, look, we're going to go lifetime for everything. ISAB said, no, we really care about this matching principle. So we have to come up with some form of own system, because ISAB argued that, you get too large day one losses if you take everything up front. And you could even have, you can even get really weird situations where like a company would have like negative equity, because basically the assets are just too lowly valued. So ISAB tried to create a compromise, and compromise, you often said, nobody will be happy. And their solution was to say, okay, look, to reduce this day one effect, what you will do is that you will, if the loan just stay on the same risk level as you took in the loan, effectively, day one, the day one effect should really be zero, but we will proxy it by using only 12 months of losses. So you will look at the PD12, so the probability of default within 12 months, and then you will look at all the losses connected to that instead. That's called stage one. And the argument for that you can do this exemption is that it's a matter of risk pricing. If I know that the loan is pretty risky, I'm also going to charge a much higher interest rate. So as long as the loan just stay on the same risk level as I thought it would be, I don't really have a real economic loss. And then I would just gradually accrue the risk over the losses over time. But on the other hand, if it turns out that, I'm completely mispriced the risk, then I need to make a quite big sort of adjustment up front to really recognize this. And you can compare it to, for those of you that know IAS 37, the standard, there you have, for example, if you are a building company and you build, let's say you build a house, and you have some expenses, but when you eventually sell the house in the end, you will get some income. What you're allowed to do is that you are then allowed to recognize, income over time, basically because you are basically constructing an asset on your balance sheet. So you recognize income and you match it over to expense. But imagine that you now realize that, oh no, this house is going to be very expensive. It's going to be much more expensive than the income I will get finally when I sell it. So I'm actually in a loss-making contract, or onerous contract that we sometimes call it. Then you really have to go and make an upfront provision for this loss right away. And it's pretty much this logic that we have in stage one and stage two. And so it's important to remember that the point of stage two is not to be a waiting room for stage three. It's not to identify loans that will go to stage three. It is to identify places where you have mispriced your risk. The problem is, however, that this concept is incredibly vague. We have sort of two outer boundaries. So if the account is 30 days delinquent, then we put them in stage two, because that's a sort of safety wall to not have them go all the way to 90 days delinquent. And on the other hand, if the company or the lender or the borrower is treated as investment grade, then we don't need to do any staging. We can just place them in stage one, because that's called the low credit risk exemption. You have to calibrate that, because you might say, okay, most of my counterparties are not rated, but then you're allowed to determine an internal rating that is aligned with the investment grade. But the problem is that there is still a lot of sort of diversity between these two boundaries, and those boundaries are pretty set, but where to do in between, it's very, very unclear. And I have a whole separate presentation, again, very happy to send if someone interested, where I talk about, what can you do and how to think about it. But effectively, already, today I was in a meeting earlier today, and where we were discussing this topic, and effectively it is really hard what to do about staging, and I would say the industry as a whole really struggle with it.
Jacob, you have about 7 minutes.
Yeah, I was about to say, we basically finished this one. So we are more or less now, and I know that we are about to run out of time. So basically, as we said, we have now gone through the standard, talk about it, how it really developed, and look about the parameters, because now I really want us to get to the question side.
Yes, you just let me know. You still have a slide to present?
Yeah, but no, but basically this just sort of summarizes what I've talked about previously. So I think we have a pretty good point to move on to questions.
Yeah, there are a number of questions, and I have given in the chats, whoever is in, I've given a link to the posts of this webinar, so that if you can post your questions right there, Jacob will be able to see them and answer them right there, because time is not really on our side. I'll just highlight a few questions. There's one question from Rajab who says, how do we account for customers who significantly increase their credit utilization shortly before default?
Yeah, and I would touch a very good question. I would say that's basically with the CCF model. So the CCF model is that if you have a history that customer tend to do this, okay, then the CCF should be pretty high. So this is really covered through the CCF model. Sorry, can you hear me?
Yes, we can.
Yes. Apologies. It's on. But yes, that is with the CCF model. So let's see if I can also get up
Go through the questions and figure out perfect. I think you should please leave your emails somewhere in the chat so that the materials can be sent to you after Jacob shares them with us. And may I, Jacob, please listen for a few questions. Jayshri, you have a question. A minute, please, and make it short and clear. Jayshri, you're raised. Yes. Jayshri? Haidari, please copy the emails that are being sent in the chat for the sending of the materials. Jayshri, there's a hand, there's another hand.
Yeah, I saw the question here. At one place mentioned that for a particular court, if customers is default and accounts get cured, in such case we should count as default. And this is a really good question. Yes, you should, and this is very important. When you calculate the PD model, you calculate time until your first default event. So even if the customer cures back, you still have to treat it as a default. And then the fact that they cure, that is being taken care of by your cure model. That's part of your LGD. So from a sicker point of view, where you typically looks at the PD ratio, okay, there you still need to consider the fact that they did default on you. So you really have to make this split between them. Yeah.
Thank you. Is there anybody else with a question? We remained with very few minutes. Perfect, Mugaga, please.
Okay, my question is, what does a typical day look like for someone who is into credit risk modeling, looking at IRB models and IFRS 9 models?
That went really good. So I would say it depends a little bit where you are in the month. So typically, imagine that you sit on like an IFRS 9 desk, for example. Typically, when you run the time where you run the models, that is, the beginning of the month. That's very, stressful times. You get all the data in, you try to get the numbers out. That's much more of a little bit of a machinery. Okay, all the data comes in, you use the machine, you're trying to get the numbers out. And you do some analysis. Why is it changing? What is different this month? Then you a little bit switch over to, sort of the in-between period, where during the month, so maybe first week of the month, that's getting the numbers out. The other 3 weeks of the month, what you then try to do is you try to maybe build the models better, you try to improve upon the models, and you look at different analysis and changes, and try again to connect the model better to the business model. So what I would say is, a lot of what it's about to work in quantitative credit risk is really to understand credit risk. You spend quite a lot of time in really trying to understand the products that you're working with. I have been very fortunate that through my bank that they've been allowing me to go out into the branches and really, get to visit, branch managers and talk to them and sit down with people. And this is my recommendation to you guys, like, if you want to understand credit risk, you really have to understand the credit process. So really spend time with the people in your organization that manages the credit sit with the people that manage the phones where customer calls in, and for example when you have collection department that calls customer, listen into the calls, try to understand what happened, you hear the stories from the customer, you hear the issues that they're having. Okay, that gives you an indication of what variables and what things are relevant.
Okay, thank you so much. David, please, Navid, 1 minute, please. Navid Barati.
Hello. Yes, this is me. I wanted to ask a question about, so after a period of time, you will start to review the model that you have created before, or doing some portfolio review. In those cases and in those situations, what would you focus first?
Really good question. So I would say let's say we start with, for example, a PD model. Like the absolute important thing first is that you determine if the calibration is correct. So what you then determine is, let's say that it's, for example, a 12-month horizon you're operating with. Okay, then you basically would check, okay, you can make a time series. You check what is the model projections 12 months ago, what was the reality of the 12 months, and you start to check how they works. It's important to say this is a big difference from how we do in, for example, IRB or in credit origination, where we will focus often quite a lot on if the risk differentiation is the correct thing, the Gini. So Gini is not unimportant in IFRS 9, but it is much less important than the calibration. And the way you can understand it like this: imagine that you have perfect risk selectivity, so you know exactly in what order the customers are in risk. You can place the customers from lowest risk to highest risk, but the problem is that your estimates of risk is 10 times wrong. I mean, then the ECL number will be 10 times wrong, and it will be quite disastrous. While on the other hand, if you don't really know who the risky customer is, but you have an overall understanding of what the overall PD level is, you're still going to get a pretty decent ECL. This is therefore the calibration level is the first thing that you need to check when you determine this. And then secondary, you start looking at the risk differentiation properties like the Gini and similar. But very good question. And there's a lot of art. I would also say, if I were to give one advice, I used to work as a validator. One advice when you do validation is don't be too stuck on tests. Yes, testing is very important, but really try to think about, is there something in this model that looks off? I run some simple calibrations and look, is there something that, stand out to me and they say, this variable choice seems weird, this seems problematic. Okay, dig into that. Try to be, the way that you should think as a validator is a little bit like a stress tester. You go out, you kick the tires, you try to understand, is there some issue here, rather than being too mechanical.
Thank you. We are really out of time. Cesar, can you make it very short so that Jacob can answer and we close this session? Cesar,
Sure,
please.
thanks.
Yes.
Yeah, hi. So, Jacob, I'm trying to isolate the dollar impact of PD, LGD, EAD, and if possible, granular components of LGD on ECL. Do you have any recommendation on that part?
Yes, really super good question. And I worked at the previous bank. I was part in building a system for this. So because you are right, like when you do a validation, this is really what you want, because you want to be able to tell management how much is the impact of each of them. Here will come a very, very speed version. Feel free to follow up on me on what more details on it. But what you do is that you first calculate your modeled ECL with everything just modeled. What you then do is that you replace the PD component with an empirical default rate. So you take PD and you substitute in substitute in if the customer defaulted or not when you follow it up. So you basically, for everyone who defaulted in a period, you calculate still the theoretical EAD and LGD, but you now just include the defaulters in your sample. So you go from sort of using a PD to just using the indicator function, did it default or not. And that first difference between these two, that shows you the sort of dollar amount, because how correct the PD is. Now you do the second step, which is that you replace the EAD with the actual default balance. So the difference between default rate and EAD versus default rate and observed balance, okay, that gives you now the EAD effect in dollar amount. And finally, you compare, the write-off amount and the write-off losses versus the LGD, and you substitute in that difference, and you get sort of the LGD component side. So as I said, this, you basically take one parameter at a time and you replace it with the observed values. This is really, and you look at the difference in the ECL value when you replaced it with an observed difference. This is how you break down the dollar amount.
Thank you so much, Jacob. As you can see, it's still hot. The discussion is still very much hot, and I concur with the rest that in the chat that it has been a very, very productive and very, very nice presentation. If you really enjoyed this, please feel free to show some love to Jacob by
and I can say as well, if someone have no more questions we were not able to cover here, feel very much free to reach out to me on LinkedIn, similar. Always happy to talk about IFRS 9, and I should express my sincere gratitude for being invited. It was a real pleasure to be here today.
Yes, I have pasted Jacob's LinkedIn. You can go and interact with him. I've also pasted the Association of the Students. We can reach the Students Association as well as I, myself, so that we can meet. We have seen your email addresses, and after Jacob sends over the materials, we'll be able to send you the materials for the revision. Jacob, on behalf of the University of Dar es Salaam, Department of Mathematics, and the students, thank you so much for accepting our invitation. And thank you everyone in the call that contributed. The chat was very much alive in the middle of the presentation, and we kept on exchanging ideas and informations about the IFRS 9 from different parts of the world. That's how you know that this is a timely and very much needed information around the world. From Tanzania, good evening from everybody, and hope to keep on in touch with you guys. Thank you so much, Jacob.
Thank you. Bye.
Thank you, everyone.
Okay, goodbye, everybody.
That's my Indian. Thank you, everyone.
Thank you, sir. Thank you, all of you. Thank you, Jacob, sir.